Welcome to the Valuation Master Class Show. My name is Andrew Stotz, and I'm going to take you through how I think about business. And I think my light's quite bright here. Hold on. Ooh, not that one. There we go. So the title for today is how I think about business finance. And one of the things that I think made me stand out as an analyst when I was younger was that I was running a business. So I also understood how to value a business, how to operate a business. And that taught me a lot about finance. And so today I'm going to walk through a presentation. If you want this presentation, just send me a message at Andrew Stotz and just say in it business finance, and I'll send this to you. The first thing I would say is there's only two reasons businesses fail. First, they fail to create real demand, or they fail to sustainably convert demand into value. That's it. That's the way I see it. When I look at a business that's a startup, when I look at my own business, when I analyze a business, this is what I think about. So we need to have some definitions here. So why don't we start off with the definition? What do I mean by fail? So in the case of fail, it does not mean closing the business, right? Fail means the business cannot reliably support the owner and keep operating without constant stress. And if the business survives only through worry or rescue or sacrifice, it has already failed. Let's define the next thing, which is real demand. What do I mean by they fail to create real demand? Real demand does not mean interest or likes or shares or compliments. Real demand means customers choose you freely and pay without being heavily incentivized. They come back and buy again at a price that works for your business. Now, I've worked with lots of different analysis over the years. Small businesses, startups, mid-sized businesses, large businesses, huge businesses. And one of the big lessons that I've learned is that huge businesses have a limited number of products or services that they scale up massively. And this concept of scaling is something that's really important as an analyst when you're looking at investing, because if you're investing in a company that can't scale, you might as well put your money somewhere else. Look for companies that can scale. So let's look at another definition. What do I mean by sustainably convert demand into value? Well, this is the core idea. It does not mean growing fast or being busy. It means the business can run, pay its bills, and survive shocks without constant rescue. Now, for demand to become value, a few things have to be true. First, cash arrives on time to pay obligations. Number two is profit supports the business at the price that customers accept. And the business rewards the owner for their time, money, and risk. After all, the owner has options. For instance, they could just get a high-paying job. Revenue alone is not value, and being busy is not value. I mentioned the concept of being busy because everybody in the business world is busy, but the question is, are we really creating value? Now, in the Valuation Masterclass Bootcamp, we've been recently looking at a company named Platinum. And Platinum has a mall in Thailand. And the Platinum Fashion Mall, which is really more B2B than, or wholesale, more than B2C. But my students calculated that the return on invested capital was lower than the weighted average cost of capital. Basically, what that means is they raise money, let's say for 10%, and they earn 7%. Ha! That's not a good business. Ultimately, in order to create value, we've got to raise money at, let's say, 10% and invest and earn on that money at above 10%, 12, 13, 14, 15, 20, 30. A company like Microsoft is earning maybe 40%, 30% return on invested capital and has a weighted average cost of capital of, let's just say, 10%. It can be 20 or 30% of value that they're creating. So we want to understand this relationship between the money that you have and the cost of that money and what you earn on it. So demand creates the opportunity. Behind sustainable value creation, owners manage 5 practical levers: demand, cash, profit, conversion, and return. Now, you don't need to master finance. You just need to keep these 5 items or levers from breaking. If any one of them breaks, chances are you're not going to be successful. Think about it this way. Without real demand, finance cannot save you. If there's no customers, nobody's buying, you're not able to scale, no matter how smart you are in the areas of finance, you won't win. Also, with demand, but no conversion into value, finance will eventually destroy you. In other words, with demand, I see many companies that have a lot of revenue, but they don't have a lot of profit. So when we're analyzing companies, we first want to see that there's that demand, that's the revenue growth. But the question is, are they able to generate a good level of profit as a result of that? That's the challenge. So this is a saying that I like, that I've created: without real demand, finance cannot save you. And with demand, but no conversion into value, finance will eventually destroy you. You'll run out of money. So let's look into these 5 things in a little bit more detail. The first one, demand, that's proof the market wants your offer. Cash, that's the lifeblood that keeps the business alive. Profit is what makes the business sustainable. Conversion is what turns sales into cash on time. And return is answer to the question, was the risk, time, and stress worth it? Let's look at the first one, demand. I just create a simple chart for you here. I look back over 30 years. I collected the data on thousands of companies, and I calculated the average annual revenue growth rate. And that number is 6%. Remember this, 6%. What does this tell us? This tells us that the average large stock market listed company has a revenue growth of 6%. Now, I bet if I had asked you, you would have had a very different answer. You probably would have thought 10%, 15%. People are generally pretty optimistic on the idea of how fast a company's revenue should grow. But in my case, what I would argue is that for a business that you're investing in, a business that you own, you want to be having 10% or above revenue growth. If you're below 10%, I think it's a sign that there just may not be demand. Take a little question, Roman. How can we scale a business that produces a generic product such as toothpaste or soap? Let's say Unilever. Well, scaling production is easy. Scaling distribution is hard. That's where you have to think, how do we get this product out to the world? And that's hard. We gotta either build the distribution channel, or we've got to participate in someone else's distribution channel. Now, in the case of Unilever and other companies like that, they actually do both. They have their own distribution process, and they also feed into supermarkets, 7-Elevens, and the like to distribute their product. So, but the point that I would make is that if we look at the entrepreneur, let's just say, Roman, that somebody is starting a new company, a toothpaste company. What they're going to end up doing when someone's in that area is that they're going to try to make every different type of toothpaste that the world wants. Anybody that says anything, hey, do you have green toothpaste? Yes, we can do that. Do you have spicy toothpaste? Yes, we can do that. And in the end, by doing that, you end up spreading yourself really thin. And that's what I call the period of time, particularly in a startup, chasing revenue. You're chasing any revenue that you can get. But eventually, you've got to narrow that down and scale that up. So hopefully that gives you some idea, Roman. Lee says, okay, so 10% revenue growth would be your line in the sand. Generally, yes. If you can't produce above 10%, then you're not terrible, right? I mean, remember we said 6 is average. So you could say, well, I'm happy with 6%. Yeah, I'm okay with that. I'm okay with average. The question is, and in investing in valuation, the question is that priced into the stock? If the stock's trading at, 0.7 times price to book, it's super cheap and it's growing at 6%, it may be worth it. And in fact, many people are buying companies because they think, okay, I want to own this company at 0.7 times price to book multiple with a 6% growth rate. I think that there's potential to raise that. And therefore, it may be that premium is deserved, or this discount is deserved at this point, but maybe it can change in the future. Now, I got a lot of cool stuff in this, so I really am excited to walk through some of it. That's the first one. The second one is cash. That is the lifeblood that keeps the business alive. Now, when I first started this idea, I was writing out oxygen. But I realized people don't really, we can't really visualize oxygen, but you can visualize blood coming out of your body, right? We've all seen it. And that means that if you don't have cash, it means you can't operate. So let's look at that for a moment. Here, I've calculated the cash as a percent of revenue and the cash as a percent of assets of all these companies over about 30 years. And what we can see is that the average cash as a percent of revenue is 15%, and the cash as a percent of assets is 11%. Now, let's just look at cash as a percent of assets for a minute. If a company had cash as a percent of assets of 70%, that's not good, right? I mean, I'm giving you cash to invest it. And so that's the first thing I would say is that we don't want a huge amount of cash because I'm not giving my money to you to then deposit in the bank. And so as a result, we want to see that cash invested. Now, what is the right level of cash? Well, right now we're at very high levels. In fact, let's look at the chart for a second. And in particular, let's look at the blue line. We can see that since 2020, companies have been far above. They've been at about 12%. It's only now that they're coming back down to the average of 11%. For a company that I'm investing in, for a company that I'm running, I would say 15% cash as a percent of assets is a good target. Any more than that, and it's too much, but any less than that, and you may not have the cushion that you need. And a small or medium-sized company needs a serious cushion because there can be down cycles. The company's revenues are not necessarily diversified. So I look for that. Now, this brings in an idea in relation to valuation, in particular free cash flow valuation, where we look at debt net of cash, but really that doesn't make sense because it's not like we would take all of our cash and repay our debt. And so what we want to think about cash is operating cash and non-operating cash. And maybe operating cash is 3%. You don't need more than 3% to operate a business, let's say. And the remaining, let's say if we have an average of 11%, the remaining 8% we can say is cushion or looking for opportunity to buy something, as an example. So we can do some work on that concept of operating versus non-operating cash. But for the purposes of today, we'll just focus on total cash. And I'd say I'd like to look for a business that has about 15% cash as a percent of assets. If they have something different or less than that, I'm still interested, but I'm going to ask more questions. Okay, let's talk about profit. What makes the business sustainable? So I looked at about 10,000 companies over 30 years. And I was able to calculate that I put it in common size, meaning 100% for revenue. And we can see for every 100 in revenue, about 70.6 goes out the door, paying for cost of goods and services. Like in my coffee business, that's coffee beans. That leaves us with a gross profit about 29%. Then the next costs are SG&A and other expenses, which is 18.8. And EBIT is 10.5, and other items are 4.1. Net profit is 6.4. This gives us an idea of what average profitability is of the largest companies in the world. Now, I thought it would be fun to look at some sectors because, people are investing in different sectors. Let's look at the nice to have sector, which is consumer discretionary. These are products and services people buy when they have extra money. Spending can be delayed, though, in tough times. It's like cars, travel, restaurants, fashion, electronics. Think Amazon, Toyota, Nike, McDonald's. So let's look at the consumer discretionary business. And the gross margin is about 27. EBIT is much lower at 7. And net margin is 4.7, much lower. This is a sample of 2,040 companies that I've done to construct this one. So we can see that consumer discretionary, despite the fact that it's a very volatile sector, actually turns out to be very low in profitability. Next, let's look at the consumer staples sector, which is the need to have. That means essential products people buy no matter what. And demand is steady: food, beverages, household goods, personal care. And Roman, I was thinking about you when you asked about Unilever because I knew I had written down Unilever here. So these are staples. Let's look at the profitability of staples. The gross profit margin is actually a little bit higher than the global average, but EBIT is a little bit lower. And part of that is because they're spending a lot of money on branding. And then net profit is 5.4. So consumer staples are very, very stable, much more stable than consumer discretionary, but we can see profit is still below the global average. So what is keeping the global average up? Let's keep going. The next sector is healthcare, where you want to stay alive and healthy. It's products and services that maintain or improve health. Demand is driven by aging populations and medical needs like hospitals, pharmaceuticals, medical devices, biotech, Johnson & Johnson, Pfizer, and the like. Here we can see the margin is incredibly high for gross profit at 41.3. And EBIT is higher than average, but not by a huge amount, by 2.5 percentage points. And that's partially because SG&A is very high for these companies because they have a lot of costs related to various things, which we'll keep simple for right now. And then other items at 4.3, then that means net profit margin of 8.2, which is very, very strong. Let's look at industrials, which build and move things, right? Companies that build, transport, or maintain the physical economy, like machinery, construction, logistics, aerospace, defense, Boeing as an example, and the others. Here we can see that the gross profit margin is much lower at 26.1. EBIT is much lower at 7.5, and net margin is a bit lower at 4.7. These businesses struggle. Part of the reason why they struggle is because they're B2B usually. They're selling their products to other businesses, and other businesses are tough. How about infotech? Companies that create software, hardware, and digital infrastructure like computers, smartphones, cloud services, semiconductors. That's Apple, Microsoft, Samsung, Intel as an example. Here we can see that the gross profit margin is not as high as healthcare, but it's pretty high at 35.3. But also SG&A is lower at only 22.9% of total revenue, which means that they get a very strong EBIT margin. They're getting it slightly differently. Healthcare is getting it from the gross profit, and Infotech's getting it from a little bit from gross profit and a little bit from the lower costs, SG&A costs. And then the final net margin is 9.4. Just incredible how profitable Infotech companies are. All right, last one, materials. Make the inputs for everything else. Companies that produce raw materials used to make other products like chemicals, metals, cement, paper, packaging. You can see some of the companies there. Here we can see a very low level, in fact, the lowest level of gross profit margin. It's a tough business. But they also drive down their SG&A costs so that their EBIT actually is higher than the global average at 11.6, and net margin is in line with global average. Woo. That gives you a picture of net margin, gross margin, EBIT margin to help you think about that factor of profitability. So let's continue and look at conversion. This is what turns sales into cash on time. And I stress the on time part. So a sale is not finished until the cash is in your bank. 4 actions to make that happen. Let's go through them. Number 1, get paid early, bill often. Don't wait until the end. Ask for a deposit. Invoice as you deliver value. And cash should move while you're working. Number 2, break work into payable stages. Big invoices get delayed, and split projects into clear stages. Bill and get paid at each stage. Make the customer demonstrate the importance of paying on time. Smaller bills get paid faster. Number 3, tighten terms when customers pay late. Late payers cost more than money. They drain your time, your cash, and your energy. When someone pays late, change the terms. And work only with clients who respect your payment rules. Next, to ensure payment is the idea not done, and not, the whole process of selling is not done until the payment is received. Delivered work or signed contract is not the end. If you are not paid, the sale is finished. I've been writing these over the last couple of days, trying to really capture my thinking on it. It's not easy, you can plug something into AI, but it spits out generic stuff. And I really try to think these things through, and it takes me a lot of time going back and forth. So that makes me feel good when I see this. Cash should move while you're working. I love that. Yeah. Now, Imani is asking, what are minimum ROE and ROCE that we should expect from a company? I would say your minimum for that is, for ROE, let's just talk about ROE. Your minimum should be probably 10% as a minimum. I think the average is about 12%. I'm actually opening up my huge file to find the exact average over 30 years, because I don't think I have it in this presentation. But let me just go to that 1 second. Okay, here we have it. Yep, 13%. So the average of global companies' ROE is 13%. Now, some companies make 10%, and if their cost of equity is low, that's great. They're creating value. So you don't want to think about ROE alone. You want to think about ROE in relation to the cost of equity in this case. So let's review. Number 1, get paid early, bill often. Break work into payable stages, tighten terms when customers pay late, and ensure payment is the shared definition of done. Now, when you follow these 4 actions consistently, growth stops creating pressure and starts building relief. And your business stops draining you and starts supporting you. And finally, you begin to feel the freedom that every business owner feels. Now, the last part of this is return. Was the risk, time, and stress worth it? Now, in this case, I'm talking to a business owner. So we can see return on assets, EBIT, return on assets, return on equity, return on invested capital, many different factors. But I like to focus on return on assets. And there's some various reasons, but I'll just explain it here. Net profit divided by average assets is what ROA is. And it shows how efficiently a company turns its assets into profit. It acts like a productivity score for everything the company owns, including cash, inventory, buildings, and machinery. A higher ROA means management is using assets efficiently to generate earnings. Now, here is my calculation of return on assets, and it comes out to 4.8% over 30 years. Now, let's look at it over time. We can see a little bit of volatility from a low of 2.3 to a high of 6.9. So a company that has a return on assets that's above 5% overall is generally, we can say, is above average. Now, we have to look at sectors better. This is going to be better at looking deep into sectors, but that's what I do. I look deep into sectors. And that's why when I look at my world-class benchmarking scorecard, as an example, I use ROA. Now, we can see that ROA actually breaks down into the net profit times the revenue divided by assets, which is asset turnover. And the end result of that is we have a measure of expense control and asset efficiency. So if we wanted to break it down, we can say the average net margin is 6.4. The average asset turnover is 0.1. Therefore, ROA is 4.8. We can also look at it that way. We can multiply the 6.4 times 0.7 and we'll come down a little bit from 6.4 down to 4.8. And here is the ROA by industry. And we can see 4.8, but some industries are very high, such as infotech, and some are very low, tech or industrial companies. So this wraps up my discussion about what I would call business finance. It's something I've been working on to try to break it down. Of course, in the Finance Made Ridiculously Simple course, which is in the Valuation Master Class Bootcamp, you go through all of this, but in a lot more detail. But I thought since I'm updating it and working on it today, I would bring it to you. As always, if you want to get a copy of this, just send an email to me at me@andrewstotts and write business finance. And that way I'll know what to send you, and I'll send you that PowerPoint. I want to thank you all for attending, and also want to remind you, don't forget to build a competitive advantage in company valuation in the Valuation Masterclass Bootcamp.